IFRS versus US GAAP. What is the difference? The IFRS are International Financial Reporting Standards which are issued by the International Accounting Standards Board. The IFRS are a principles based approach to financial reporting. What do I mean by principles based approach? The IFRS provide you enough flexibility to pick up accounting policies that best suit your reporting requirements. For example, in IAS 40, which is investment property, the mandate is pretty clear. You have a policy choice. You can either show the investment property at cost or you can show it at the fair value. It depends upon the economic conditions and the economic realities of your business along with your financial reporting requirements. On the other hand, there are certain parts of the accounting standards where the scope for interpretation is less. However, IFRS is, as I said, a principles based approach. It outlines a broad stroke, it gives you certain basic principles of accounting, gives you guidelines on how to account for a transaction in a particular situation, but it also allows you the flexibility to use a slightly different approach if that is more suitable for your scenario. For example, IFRS 9, financial instruments. There, they have given very clear classification of which financial instruments should be recorded at amortized cost, investment in debt I am talking about, which of them should be recorded at fair value through OCI, which of them should be recorded at fair value through P&L account. They have given very clear classification for each of these. But the IFRS give you a flexibility, they give you a choice here. What kind of flexibility? That if using the fair value through OCI approach helps you to avoid an accounting mismatch, then even though the original classification is the amortized cost method, you can show those debt instruments in your financial statements at fair value through other comprehensive income. Why is this done? This is done in order to avoid potential clashes and situations of an accounting mismatch. Now, when I am talking about the US GAAP, the US GAAP is a rules-based approach. It is applicable only in the United States of America. There, you don't get this flexibility to change the accounting treatment or to change the presentation just because you want it to reflect the economic realities of the transaction. It is rules-based. Like, say for example, company law. If this happens, this is what you have to do. They do not give you any choice, relatively far more rigid. For example, the impairment test in the US GAAP is very stringent. Even if one of the conditions is not met, the impairment cannot be calculated in that particular manner. So, the major difference between the two, IFRS and US GAAP, is that IFRS is principles based, US GAAP is rules based. Also, IFRS are recommendatory, IFRS have been introduced so that all the countries in the world can adopt them and make their own accounting standards exactly similar to IFRS and issue them in their own country. US GAAP on the other hand is issued in the United States of America for companies which are working there. It is not applicable anywhere else. For more such interesting updates, please follow our YouTube channel and download the Plutus app.